Hello, thank you for joining. Today we are going to be talking about depreciation expense using the straight line method. As you remember in your accounting courses, straight line method it is allocation of costs. Is it is not for valuation, asset valuation. So it is very important to keep that in mind. I'm including that part in the top of this spreadsheet. I'm using Excel workbook to put together this example, and we can walk through each part of it. So I'm gonna be working on straight line, only on straight line. There are other methodologies that we can discuss in another videos, and we will try to make sure that you understand the simplicity and the good features that has depreciation expense using the straight line. Uh, it attempts to record the cost of the equipment in a consistent or evenly systematic manner on every year of the useful life of the asset. Remember, this depreciation it is for fixed assets like property, plant, and equipment. It excludes land. Land it is not part of the depreciation expense methodology calculation. Uh, let's put together some important data up front just to make sure that we put together our example. I will be putting together also the spreadsheet, so making sure that the spreadsheet looks nice and as well as will be as informative as possible. As you can see, I'm including cost, which is all costs incurred to make this asset available for its intended use. Remember that not only is the purchase price, it will also the taxes, the insurance, the installation, and the trials, just to make sure that that fixed asset is available for use. For our example, we will use a cost of 22,000 equipment that costs 22,000. We will include a useful life of 4 years, just to make it simple and easier to calculate our depreciation expense. We're going to use on a yearly basis, so you have 4 years. Our residual value is going to be 2,000. I'm using 2,000 because I would like you to show you how you should set up your table depreciation. If you have no residual value, just leave it in blank or zero, but always take into consideration residual value just to make sure that you do not miss that one. That is one of the biggest errors that typically happens when you're calculating depreciation expense, that people miss the residual value. So I'm including the residual value, so we will keeping that in mind. And remember, if it is not, then it's zero. And our solution, we will set up some columns, one for the year, one for the depreciable cost, a depreciation rate. I'm making nice the columns. I'm just setting up the wrap text, and making sure that all our columns they are properly named. And here I'm putting the year. It will be 4 years from 2018 and 19, and then we need to autofill the rest of the information. It is only 4 years, but if it is 20 years, then the autofill function of Excel is very useful. And basically, the depreciable cost, it is a simple calculation. It is cost less residual value. So I'm going to include also the depreciable cost, just to make sure that we take that into consideration. Meaning, 22,000 less 2,000, it is our 20,000, and we will place that value. I like to use formulas, the equal, and just to make sure that if we make any changes in the upper part of our table, it will autofill or it will correct itself. So making sure that our Excel is an is as intelligent as we would like it to be. The depreciation rate basically is dividing 1 divided by the useful years. That will give you the percentage. Remember that you have to include all the years when you are calculating the depreciation rate, since it has to equal 1. If you see the sum has to be 1, that would be 100%. If you have A, you have to have 1 divided by 8, and you have to have A lines or A rows. Or if it's 5, then 1 divided by 5 and have 5 rows. So you will have 100% of your depreciable cost available. So keeping that, it is very important. Depreciation expense basically is depreciable cost times depreciation rate, and that will give you the 5,000 that it will be our depreciation expense. As you can see, we have already set up part of our table, and basically if you add the depreciation expense for the 4 years, you will note that it will sum up to, or it will add to 20,000, which is our depreciable cost. That's why we want to make sure that we have all the rows that will, when you calculate the depreciation rate, it will go to 1 or 100%. Then the accumulated depreciation is accumulated. So the first year you will have the 5,000, then you will add the 5,000 from first year to the second year, you will have 10,000, and then the second year, that is 10,000, with the third year 15,000, and so on. And the book value, as we calculated, we will subtract and we will get a book value. Remember, the book value, it is not the fair value, and we have a mistake here we have to correct. And because I have put residual value as 0, I have set 0, and it has 0 at book value. But remember that we want a residual value of 2,000, so we need to make a small change here. It cannot be a 0 book value, since we have already set up that it is 2,000. This is something good to have, because you will be able to correct whatever mistake you have. And in this case, let's say for example you have to take the 22,000, subtract the 5,000, and you will get 17,000. And now we can make the proper corrections to our formula. From the 17, now if you subtract 5, you will get 12,000, and then you will get 7,000, and at the end you will get the 2,000 that we need to make sure that we do have as our residual value. As you can tell, if I eliminate the residual value, it will go to 0, meaning that we have already set up the correct amount. So now we will place that back. 2,000 is our residual value. Remember, residual value does not mean the fair value. Book value and fair value, they are not necessarily equal. This is just a measure of accounting books. What we want to have in our accounting books, either 0 or a residual amount, and that's about it. Fair value is another concept. So we are not worried about fair value here. We are just about working on how we are allocating costs between the useful life of a fixed asset. And remember, fixed assets are property, plant, and equipment, and excludes land. Land is not a part of the depreciation expense calculation, keeping that in mind. Now let's work with the journal entries, and now we are putting together what it is, the depreciation expense and the accumulated depreciation. Remember, every year you will have, since it is a straight line, you will have the same amount. It is the same amount for depreciation expense, the same amount for accumulated depreciation. The only difference is that depreciation expense is an operational or nominal account, which means that every accounting year end, it will go back to 0 with the income statement, the closing of the books. The accumulated depreciation, since it's a real account, it will stay because it is a balance sheet account. It is a contra account of the PP&E or the fixed assets or the equipments. So therefore, you will have accumulated depreciation being part of your calculation of the balance sheet. So what we have here is the 4 years, and as you can see, it will have the same amount since it is a straight line. Depreciation expense and accumulated depreciation each year with the 5,000 amount. It will be the same calculation if you have several equipments or several properties. It's just a matter of adding all up. So let's put together the balance sheet presentation just to make sure that we understand what we're doing in terms of what we are working in terms of the balance sheet. Now, let me put together this balance sheet and make sure that everything is set up right. Let me include the 4 years that we have already set up, and let's do the autofill function. Remember, since it's 4, you can put them all, you key in or use the autofill, because if it is more than 4, if 20, 25, 30 or 100, it will be able to autofill for you that information. All you need to place is 2 amounts and then it will take care of that. The cost, it will be the same. The equipment cost is 22,000, so we will take care of that basically and have the 22,000 for equipment for every year, and the accumulated depreciation will be an incremental value up to the depreciable cost of 20,000. As you can see, for every year you have 5,000, an increment of 5,000, and then the net equipment, which is the book value, it is the subtraction of equipment accumulated depreciation, and you will get all the way to 2,000 at the end, which is the end value for accounting books. That will be your presentation of the balance sheet. What about the income statement? Let's put together what it will look like, the income statement, but how, since we don't have more information, we will just place revenues, expenses, and then underneath expenses we will have depreciation expense as below the line from the expenses group. So we will have depreciation expense, and we will have the 5,000 for every year. Remember, it is a nominal account, so it will be closed out at the year end, and it will only have 5,000 for every year, since the accumulated depreciation is just an accumulated amount. So there you have it. Pretty much this is all that we have for today for depreciation expense. Thank you, and please join, subscribe, and if you like it, please thumbs up. Thank you very much.